Good afternoon. I'm Sherry Madeira. I'm the CEO of CDP, the world's climate environmental data disclosure system, representing over 2/3 of the world's market cap and comprising 1,100 cities, states, and regions that disclose to us. Today, I'm delighted to welcome you on behalf of the Investor Agenda founding partners, who are, brace yourself for the acronyms, AIGCC, CDP, CERAS, IGCC, IIGCC, PRI, and the UN EPFI. So, beyond representing most of the alphabet, we're a collective force that has been accelerating investor action on climate change and supporting investor advocacy to policymakers on the importance of meeting the goals of the Paris Agreement. Our role as founding partners underlines our commitment to a holistic approach towards sustainability. For global investors, transitioning to net zero can be very complex, and investors need clarity, guidance, and support. That's why the Investor Agenda developed the Investor Climate Action Plans, or acronym, ICAPs, a framework for investors that highlights the key actions they need to take to help accelerate the global transition to a net zero economy. We're proud that as of this year, ICAP's guidance will include tackling deforestation as a key element to address climate change and to reduce emissions. Today's event is a testament to our dedication. We will delve into critical discussions on how investors can accelerate and scale up their actions. Our first panel, expertly moderated by Stephanie Feifer, who I've already seen work her magic earlier this week, the CEO of IIGCC, will explore ways to fast-track investor climate initiatives. Followed by David Atkins, again, a prolific speaker, and the CEO of the PRI. Last time we were together, I think, David, we were in Beijing and following each other on stage, so sounds like we're doing the same dance here too, which is great. He'll moderate a panel discussing the needs for increased investment in climate solutions and the essential role of government support. We're witnessing a growing recognition from within the private sector of the urgency to scale meaningful action towards de-risking climate impacts in portfolios, engaging with portfolio companies on decarbonization, and identifying and maximizing the opportunities in transition finance. The more than 24,000 entities that are disclosed through CDP in 2023 indicate that the private sector is not only tuned in to environmental risks, dependencies, impacts on the warming planet, but that they are beginning to see the opportunities inherent with a resilient, equitable, and net zero future. An important trend for non-state actors to be called out on their desire for transparency. But let's be clear, the role of government in climate is critical, and we have to get that right for the future. We need policies and frameworks that uphold the principles from the Investor Agenda Changing Climate Policy Landscape report, which outlines key recommendations for effective climate policy. It is particularly vital for directing capital towards large-scale, sustainable solutions in emerging markets. Policy and emerging markets. For me personally, these are things that really must be part of our top-tier agenda. The aspirations for a net zero economy must be matched with robust mechanisms for transparency. The principle lies at the core of CDP's high-quality mandatory disclosure principles. There is an acronym, I will skip it. These principles serve as a call to action on policymakers and financial regulators to ensure integrity and scientific rigor are the backbone of environmental reporting. Policymakers are not data experts. I have learned this from my past life, and I'm learning it again as the new CEO of CDP. That's what we're here to do. That's what we're here to support. To drive momentum, transition is a critical part. In fact, transition needs two things. It needs a baseline, and it needs a science-based, time-bound target. And not only that, we need to make sure we understand what actions are happening between point A and point B, which means we need more monitoring, we need more transparency. And again, that's where CDP is here to support. Policies on disclosure and transition must be comprehensive, sector-specific, and the scale needed to match the ambition of private sector commitments to keep global temperature rising below 1.5 degrees and to halt nature loss. Ultimately, the managed phase-out of fossil fuels is a non-negotiable aspect of our collective climate mitigation strategy. This objective should be incentivized through financial and fiscal policies that are designed to make green investments not just viable, but attractive. In closing, I extend my gratitude to all of you for joining us today. As we move forward, let us all strive to hold ourselves and each other accountable for the implementation of a comprehensive Paris-aligned roadmap. And now, it is with great pleasure and honor that I introduce Adam Wang-Levine, Deputy Assistant Secretary for Climate, Environment, and Infrastructure at the U.S. Department of Treasury, who is well qualified to set the stage for our discussions today. He is also relatively new to the role, so we've made a pact to make sure that we're going to keep in touch and make sure we hold each other to account. And I'd like for you all to welcome him together with me to the stage. Adam.
Thank you, Sherry, for the introduction, and I'm very glad to be part of this important event today. We're also very supportive of the work that Ceres is doing to support investors' commitments to reducing their exposure to fossil fuels. We're very supportive of every effort that we can make to increase investments in Paris-aligned companies and projects. And while we know that there are a number of ways in which these investments in climate-positive projects can produce attractive returns, we also recognize that oftentimes there are barriers to making these investments and a role for the public sector to play, which I'd like to highlight with some of the work that we do at the U.S. Treasury. As Sherry mentioned, I recently joined the role and was actually working in venture capital in Silicon Valley, so I'm very familiar with some of the frictions that we might encounter when trying to make these investments. I'm going to use some more acronyms, so bear with me, but I'll explain what they are and more highlight the concepts. But I'd like to highlight both international things that we're doing at the U.S. Treasury, as well as domestic things that we're doing. I might start with some of the international, just because I think we've all heard about the Inflation Reduction Act, but actually mobilizing private capital towards climate is something that's very important to the U.S. Treasury. The first thing that I'd like to highlight is our role with MDB evolution, multilateral development banks. So we're very much looking forward to how we can make the World Bank and other regional development banks work better and increasingly work with private capital investors. Janet Yellen, our secretary, has been leading a process called MDB Evolution, which has been trying to make these banks have a better grasp on how they can use their balance sheets. And in this next year, we're starting to look at ways in which the MDBs can work with the private sector. We're thinking through concepts in which they can provide guarantees to private capital investments, potentially offer securitization structures to allow additional investors to invest in their products, and generally look at blended finance as a concept. A second thing that I'd like to highlight is I represent us at the G20, and I'm the chair of the Sustainable Finance Working Group. And some of you may have heard about some of the priorities that we're going to have in this next year in Brazil. One thing that I'd like to emphasize is with Brazil, we'll be leading a review of the climate finance architecture. Basically, the concept that there are a number of multilateral climate funds that exist, and we want them to work better for the entire ecosystem. A part of that review, which we'll be undertaking in 2024, will be seeking ways in which the funds, like the Green Climate Fund, the Climate Investment Funds, and others that you may have heard about, can allow for more access for donor country or recipient countries, as well as increasingly work with the private sector to mobilize capital. A third and final international effort that we focused on are, another acronym, JETPs, our Just Energy Transition Partnerships. Some of you may already be familiar with these programs, but they're ways in which we're trying to mobilize both private, public, and philanthropic capital under programs that can help countries, particularly in emerging markets, make their energy transitions. We had the opportunity to actually celebrate the recent launch of the Indonesia Comprehensive Investment Policy Plan here recently at COP28. And we very much look forward to finding ways in which we can work with international investors to include them in these projects, which include South Africa, Senegal, and many other countries, we hope. Finally, I'll turn to some of our domestic efforts. In September, Treasury launched our Principles for Net Zero Financing and Investment. And we've seen over 100 institutions make voluntary net zero commitments. What we wanted to do with these principles, which are voluntary, was provide some guidance on ways in which institutions can make the transition to net zero. We seek to provide some insight and reassurance on how you can make transition plans and other concepts that many of you are familiar with make more sense and articulate the principles in which we think that they could be implemented. Finally, I'll turn to the Inflation Reduction Act. As many of you know, we think it's an incredibly important way in which we can reach our Paris goals. By some estimates, we may reduce our greenhouse gas emissions within the United States by over 40% by the end of the decade. And so we think it's a tremendous opportunity to reach our Paris goals, but also to provide private investment opportunities as well. We think that we can usher in a new wave of industries that private investors can invest in. I'd like to thank Ceres again for this opportunity to participate in this discussion and very much look forward to the panel. Thank you.
Good afternoon to everyone, and welcome to everyone in the room, as well as those of you on live stream today. It's really lovely, as always, to see so many familiar faces at the COP, and very glad that you're participating today. I'm the CEO of IGCC. My name is Stephanie Feifer. IGCC is a membership organisation for investors, for asset owners and asset managers. We've got around 400 investors in about 27 countries, representing around $65 trillion in assets. We are also a founding member of the Investor Agenda, together with all the partners, all the acronyms that were mentioned earlier on. We were a co-founder of Climate Action 100+, as well as a co-founder of the Net Zero Asset Managers Initiative and the Paris-aligned asset owners. And we really work with investors on setting their ambition, helping them set targets, developing frameworks and guidance together with them to help them implement on their plans. Either through asset allocation, stewardship, or policy engagement, or indeed engagement with the wider market. So I'm really excited to discuss with this really esteemed panel how organizations, how investors have set their climate targets for their organization, how they're implementing their targets, what are the barriers, what are the challenges, what are the opportunities, and how are we all doing to help with that global goal of the Paris Agreement. So I'm going to introduce, first of all, on my right, I have David Neal, who is the CEO of IFM Investors, and we actually had the pleasure in reverse roles yesterday on a panel as well. Then we have Ozeki-san, who's the president and CEO of Nisai Asset Management. So thank you for joining us. And on my left, I have Eric Decker, who is from AXA Group Investments. So we have a good sort of international range of players here. And David, I'm going to turn to you first to sort of help me set the scene a little bit. But obviously, you're also a signatory to the Net Zero Asset Managers Initiative, and you committed to net zero by 2050 or sooner. But I really want to get your view first, sort of in general, where do you think investors are on net zero portfolio alignment, and how has that understanding sort of changed in the last few years, what it means to be an investor with that kind of target, and how's that understanding evolved?
Yeah, thanks, Stephanie. Good to be here. Thanks for having me on your panel, the return match from yesterday. So it's kind of setting the scene a little bit to answer that question. So IFM's kind of slightly different sort of organisation. We're founded and wholly owned by a collection of investors, and those investors actually represent the communities themselves. They're not-for-profit organisations that are very member-focused. They represent nurses, teachers, construction workers, hospitality workers, those sort of things. So that set of investors that we work for and that own us, and still a substantial amount of our capital, they're very much focused on sustainability. They represent the community, and so sustainability is important to them. And the net zero alignment and progressing towards a sort of healthier world is a really important part of their proposition. But it's also very clear to them and us intuitively that if you're going to generate great long-term returns, you need to have a healthy system in the future. If you want a 20-year strong return, then the system in 20 years' time had better be healthy, both economically, environmentally, and socially. I think that message that is at the heart of our owners, that message, I think, is getting out. I think it's got very strong momentum over the last few years. If I think back 3 or 4 or 5 years ago, it was a much more patchy understanding of kind of, well, why are we doing this, and is this what we should be doing? Is it what we should be focused on? I think it's become much more embedded in the industry. There's still differences around the world, of course. There's a different level of buy-in. There's a different balance between doing good and generating returns that exists. But I think it's certainly become a pretty strong theme. I think the other thing about it, that level of commitment has gone up. I think the other thing that's really interesting is that the alignment around what commitment looks like has got a lot stronger, and that's really important for those of us who serve multiple investors. It's very difficult when people have a different idea of what it is they're trying to achieve. And of course that is a friction on the system, because it means you can't mobilise capital as efficiently as you might do otherwise. So the work that all of these various acronyms that we've been talking about are doing, and particularly your work, Stephanie, in creating frameworks that we can align around for what we mean by our targets and how we progress towards them and how we measure it, I think is incredibly important work, and it's certainly achieving its objective, I think. Just one sort of slight word of kind of caution in there, or one issue that I think we still do reckon with a little, is that the idea of climate solutions is very clear. People understand that, investing in renewable generation and other parts of that sort of sector, but I still think there's a challenge in getting enough capital in for transition work. That's still difficult. You've still got some investors who say, why have I got emissions in my portfolio? Take them out. Well, you can't, as Mark Carney says, we need a fair amount of capital to go where the emissions are. And that's a really important feature, and we need responsible investors to be deploying capital into that space to bring emissions out. And I think that's still one area where I think there's some investors who are challenged by that.
That's a really, really great intro, and we've seen the net zero alliances. I think there's over 300 asset owners and asset managers now in those alliances jointly between the 3 alliances. So I think we've seen significant growth despite the backlash also in some areas of the world. So I think that really does show the commitment. And the understanding is changing. We, for example, we have a net zero investment framework, and it's very much looking at different assets and how do you transition those rather than perhaps just having a top-down target. So the understanding, as you say, has also evolved as we've sort of seen more of these commitments and people have started implementing those. I'd like to turn now to Ozaki-san, and you are, as Nissay Asset Management, a member of the Net Zero Asset Managers, but of course you are also part of the wider Nippon Life Group and also bring the perspective of an asset owner. And I'd love to hear from you perhaps how you have started addressing climate change, but how did you go about setting those targets for yourself?
Thank you, Stephanie. It's okay? Yeah. Nissay Asset Management, as you pointed out, half of our AUM comes from a Nippon Life Group, and half of our money from a pension investor like a GPF or others, and other financial institutions and retail market mutual fund money. So we are half and half asset owners and asset managers characteristic by nature. So when we started Nissay Asset Management initiative, Nissay Asset Management joined the Net Zero Asset Owners Asset Managers Initiative in March 2021, and set a goal to halve the financed emission for all the equity and the credit asset by 2030 compared to 90. For the first 2 years, our finance emission dropped by about 25%. So far, not so bad. And when I look back our investor climate journey, we started our climate-related investment from a thematic bond investment, such as green bond and sustainable bond issued by the City of Paris or London Transport in 2014, when I was the chief investment officer of Nippon Life General Account and as an asset owner. So as an asset manager, Nissay Asset Management started our ESG Japanese equity fund from 2008. So Nissay Asset has focused on blue chip ESG leaders investment with high ESG scores. It was a good start. However, when we look into our portfolio in terms of GHG emission, only 10% companies in numbers in our equity portfolio emitted 90% GHG emission among the whole portfolio. So it means we could achieve the 90% reduction of GHG emission by divesting 10% companies. It's easy, but clearing up only our portfolio apparently means nothing to achieve the carbon neutral as a whole. So through the continued engagement with our investee companies, we keep asking and supporting the high emitting companies to transform their business lines. We believe the transition of those companies is beneficial not only for the net zero as a whole, but also for the future of their own business. So we hope to build up such a win-win relationship with in our investment supply chain. And in addition to our engagement efforts, we as a Nippon Life Group are also actively pursuing impact investment opportunities. So such funds invest in the innovation such as energy efficiency, green hydrogen, recycling CO2, direct absorption of carbon emission, and so on. So for example, Nippon Life emphasized ESG and impact investment and plans to double its current investment ESG themes to 5 trillion yen by 2030, of which 3 trillion yen will be invested in the decarbonization related investments. We would like to continue to support the creation of an impact or sustainability outcome throughout the Nippon Life Group. As I mentioned, we always seek for the creation of a win-win situation with our investee companies, but of course it's not easy. So during the engagement processes, we always face challenges. So some major blue chip companies in Japan, such as Sony Group and Shiseido, a cosmetic company, have already achieved the SBT's net zero certification. They are great, but they are not a maturity yet. So in order to achieve the net zero in our portfolio, we focus on our engagement and the milestone management on about 70 high emitting companies around the world, so which accounts for the 70% of our financed emission. So Japanese companies among 70 high emitting companies is 43. So what do you think, how many companies, Japanese companies who committed net zero already has no plan, concrete strategy in place? So the answer is 3. Only 3 among 43 Japanese high emitting companies has a concrete strategy in plan for transition. So less than 10%. So that means more than 90% of high emitting companies in Japan who committed net zero already don't have a concrete strategy in place yet. Why? There are many reasons, but one thing is sure, they lack their own incentives to drive further towards net zero compared with lots of excuses that good Japanese practitioners can easily imagine. So based on these experiences, or even though we have faced these challenges, we would like to muddle through this journey, working together, the company and the public sectors to achieve net zero goal to secure our own future.
Great, and thank you for sort of highlighting one of the levers that investors have to drive real economy change, which is, of course, corporate engagement, stewardship, and there's that core group of companies in your portfolio that's sort of most important for most of the emissions. And also the role of policymaker. You obviously need the signals for those companies to move, but you as an investor obviously trying to make that change, and that is part of a lot of the frameworks that we've developed, the importance of stewardship and engagement and escalating that engagement over time. And it's also, a lot of us co-founded Climate Action 100+, and that's sort of the principle behind that as well. So thank you for highlighting that. Eric, if I could turn to you now and hear a little bit about what you're doing at AXA Group on climate and the targets that you've set, but also I suppose a lot of people have said this is the year of moving from targets to implementation, and I wondered if you could tell us a little bit about how at AXA Group you're working on that implementation.
Thank you, Stephanie. Thank you for the invitation to share our practices at AXA. So just a bit of context to understand the targets. AXA, large asset owner, P&C business, life business. It's always important to stay on the stage. We are much larger, probably 2/3, 3/4 of the book is life, so backing saving products, and then about a quarter to a third on P&C. Long duration on the life books. So the way, once I'll go over the targets, but the management of those targets have to be, taken into account. You need to take into context and the profile of the company that you're dealing with. We don't have the same balance sheet profile than a pure life or a pure reinsurer or a pension fund. So all of the asset owner or institutional investors can all be put in the same basket. So we joined the AOA in 2020 after having made the commitment net zero late 2019. Our first target was minus 20% between 2019 base year and 2025, and this summer we changed or we updated the target to minus 50 between 2019, same base year, and 2030. Basically, the balance sheet, we can split it into three, which is the basic corporate book, and then on which we have a decarbonization strategy, and really the minus 50% today is on that large corporate book with real estate. And then we have a private asset practice, and there it's not really decarbonization as such. What we want to do is we look at it more on a transition basis, investing more in financing of renewables. And then a third pillar is something that we have started a few years ago, which is investing in nature-based solutions. So for the moment, just doing carbon credit type of investments. And we've just put one toe in financing agriculture projects through a third-party asset manager. So if we go back on the implementation of the larger book corporate, it's important that we cannot move in one single day. We are a buy and hold investor. We can only move as fast as the duration and the maturity profile of our holdings. We are not, so I always like to talk about divestment, because divestment sometimes means different things to different people. Divestment does not mean you're selling. Divestment means that you will not reinvest necessarily in the same company. You are divesting from the company, but not through selling, but by not reinvesting. Not quite the same thing. Why? Just for ALM reason, for accounting reason, for regulatory reason. So we are not sellers. Very little selling, except when we have exclusion and management decides to move faster on exclusion than the regular maturity schedule of our bond. I agree with Ozeki-san. in fact, when you look at the corporate book by sector and by name, very quickly you see where your financed emission are coming from. I mean, there is no secret. Our 80% of our financed emission are on a couple, 3 sectors, always the same for, I suppose, all of us. Oil and gas, utilities, cement, basic industries, that's it. All the rest, basically not much. There is a question mark on financials, and this is something that we would like to have more information on scope 3 of banks, because that's the elephant in the room. It's public information. Banks account for about 30 to 40% of our book. So depending on the scope 3 of banks, then we may have some surprises the day we have the data. So we are starting to make decisions on banks, not having yet the information on their scope 3. So thank you for CDP or all the other initiatives to move as quickly as possible to have all kind of information on scope 3 from banks. And we will deliver also our own scope 3 as an insurance company, of course.
That's great, thank you very much. And you've already sort of hinted at one of the key issues that investors might have, which is sort of access to data. But I want to sort of stay with some of the challenges and sort of what you're finding as you're sort of implementing your targets. And David, if I could sort of turn the question that you asked me yesterday to you now. What do you think? We obviously have investment gaps both on mitigation and adaptation, and we know there's huge amounts needed to really finance this transition. Why do you think they are, and what can we do about it?
Well, I think there's a few elements to it, isn't it? Some of it is, I listened to a John Kerry session yesterday where he talked about we've got a lot of the tools in place. What we need is the right mindset. Too often that's what's lacking. And what we're trying to do is to bring a bit more innovation and creativity to solving the problem. If there isn't a solution immediately available, then you kind of need to go and look for it. We're a private market manager, so we have control over the assets that we own, and there's really nowhere else for the accountability to sit other than with ourselves. It's our job to make the assets transition as rapidly as they can. But in some cases, so we're a significant owner of airports. In some cases, solutions are available. So with Manchester Airport, we can put there are opportunities for us to create a partnership to deliver sustainable aviation fuels, which is really the key to decarbonising an airport. The vast bulk of the emissions associated with an airport is the fuel that's burned. But in Australia, there is no sustainable aviation fuel sector whatsoever. So we had to go and find a partnership. We've announced a tie-up with GrainCorp in Australia to look at building a sustainable aviation fuels sector so that we can solve the problem. It didn't exist. We're kind of stranded as an airport in decarbonising if that doesn't exist, so we've got to go build it. So I think there's that kind of mindset of looking beyond your own remit and looking for solutions. So I think that's got to be a big part of it. At the risk of venturing into the space of where I think the next panel is going to go, I think that clearly governments have got a big role to play here. There's particularly in the infrastructure space, it's an essential service. It's inherently a community and a sort of a political animal, and so it's all very well trying to encourage people to build more renewable generation capability, but if you haven't got the grids to connect it to, then that's obviously not going to be effective. There isn't going to be the capital deployed. But that requires, so we've just talked, we gathered about $1 trillion worth of assets from the major asset owners in Australia together to create a single voice to government about what we thought a sensible clean energy blueprint would be for the government to follow. Because I kind of have some sympathy for the government here. They've got a fiendishly difficult problem, master planning exercise, and they hear 1,000 voices about, no, you should do this, no, you should do this, you should do this. There'll be a procession of people, all with their own views, I'm sure, outside the door of the various ministers. So, our view was, well, let's try and bring the key voices together and present one solution that can be discussed with government. Simplify the collaboration, if you like, and hopefully that way that can kind of unlock the policy dilemma a little more rapidly, because I think that's a big blockage to getting things deployed. It's that master plan, and then it's things like the permitting and the planning and those sort of things. So, I think those would be the key points.
And we're at a COP, so we can't not mention, that's why we're here. We have to mention that policy is at the basis of everything, and you being able to sort of scale up the investments that you want to make for a Paris-aligned future as well. So thank you for raising that. Zeki-san, I wanted to turn to you now again, because obviously you're here from Japan. I wanted to hear a bit more about what's happening in sort of the Asian markets, and if you see any differences there, and what your particular challenges might be.
Okay, thank you very much for asking. If we consider sorry for that. In Asia, we have a lot of difficulties in the renewable energy power construction geographically. So that is one major challenge for to Japan and also ASEAN countries or others. So, when we think about transition finance or transition investment, this kind of investment will naturally include investment in innovation, such as renewable energy, as well as investment in the transition for companies that currently emit a lot of CO2s. Some companies will also be at great risk if the carbon pricing or border carbon taxes are introduced, or if Scope 3 disclosure implemented in the near future. So net zero, especially in the Asian companies. So net zero is a major risk and opportunity for long-term investors like us. And responding to it well will have a significant impact on our returns on our investment. So our ESG and impact fund also invest in the global companies that benefit from U.S. Inflation Reduction Act, such as sustainable aviation fuel manufacturers and green hydrogen products. We have also launched the equity transition strategy for Japanese companies, investing in high-emitting companies but are trying to change, and in companies that provide technical support to high emitters. So far, the fund performance has been good. So Japan's challenge is that it uses fossil fuel for about 70% of its power generation still, and it is not easy to reduce fossil fuel to zero while focusing on the stable supply. To adapt these challenges, Japanese government is committed to investing 150 trillion yen over 10 years in climate change measures to support transition. But the problem is that it is not still unclear. It is not clear where and how much they will spend those money. Recently, GPANS issued a technical review note on the definition of a transition finance. So before that, the GPANS Japan chapter put forward a concept to broaden the definition of transition finance and make it easier with disciplined way for investors to fund it in order to achieve net zero sooner. So if the project qualifies as a transition finance, it may be possible to carve out financial emission from their portfolio in the future. So if investee must commit coal sunset deadlines to be qualified, it would provide incentives to the government, companies, and investors as well. Looking at Asia, the age of power generation facilities is young, and at this moment, fossil fuels are expected to account for 40% of electricity even in 2040. So Asia is a world's manufacturing base, producing real, non-virtual, physical goods, and a big exporter to other parts of the world. In that sense, we could say developed countries are exporting their emissions to manufacturing countries. So in order to achieve net zero goal globally more quickly, all the governments, companies, and investors in each country must cooperate with each other, taking this situation into account. Collaboration between state actors and the non-state actors will become increasingly important in the future, and we, Nippon Life Group, intend to take positive actions as an investor.
Thank you so much. Yeah, that theme of collaboration between public and private has gone throughout this COP, hasn't it? And really appreciate you mentioning that. Also, sort of differentiated pathways for different countries are, of course, important. And when we're looking at our net zero investment framework that we've developed for investors, we're certainly going to be looking at it again with that lens. So thanks for that. Eric, I'm going to give you the last word to sort of talk to us a little bit what you see as the key, both the key obstacles, but perhaps also the key opportunities that you see for investors in terms of aligning your portfolio to net zero.
Well, one key obstacle at first, and we had to overcome it at the AXA Group, and which we did successfully. My first, usually, key success is leadership at the company level. I think, it is hard to move against, management who would not want to move fast enough. We were lucky enough to have a couple of CEOs that were present on the various scenes and internally moved the topic. And this is why we announced our net zero in 2019 and then decided to join the AOA at that time, which has been kind of our main alliance coalition partnership, to move our portfolio. So it's super important to have a champion inside companies at a super high level. You cannot move to the real obstacle, which is really making choices at investment level if the managers don't feel pressured and don't feel backed by senior management. So number one is having the leadership at the top level, because you're going to have hard choices to make in your portfolio allocation between asset classes, within an asset class, or within sector of that particular asset class. Minus 20% was easy. It's public knowledge. We had minus 35 versus our base year on the three asset classes I've mentioned. But I think choices might be a bit more difficult, to get to minus 50. So culture is important because, as I mentioned, we are long-term investors. We don't sell. We reinvest at the time of maturity of bonds. It's a no-regret move. When we buy a bond in 2023, 24, for another 10 years, that's going to be maturity not before 34. It's going to be in our target of 2030. So between the next 3 years, basically we are building our result of 2030. So, the teams, they need to feel comfortable in the choices that they're going to have to make, and mostly in the sectors, which are basically covering most of our finest emission. And then moving more towards on the private assets, on alternative to fossil fuel. We at the AXA Group don't have the knowledge, expertise, and teams to be present on every single opportunity. So we need to participate more in third-party proposals, GPs. We need to see more vehicles at scale, in which we'll invest. So we have to decarbonize, no regret move, transition plans, super important, efforts on the banks to have their scope 3, and more vehicles on the private assets. Thank you.
Brilliant. I think that's a good place to close. I hope you've heard there is ambition from investors. The understanding of how to implement net zero targets has evolved, but that implementation really depends on leadership and culture. It depends on thinking holistically about solutions. It depends on having a definition for transition finance and stewardship. It depends on products as well. And most of all, perhaps, it depends on policy. So Thank you for a great panel, and I'll hand over to David Atkin now. Thanks.
Well done.
Well, I thought that was a great panel. It was a really interesting conversation. But this is a very complimentary one, as Stephanie mentioned. There's only so much that investors can do. We need an enabling environment from a policy front that will get capital invested at scale to deal with these existential threats that we're challenged with. So I'm David Atkin, CEO of the Principles for Responsible Investment. The PRI is an investor association where we have about 5,500 signatories across 100 countries and who are all working to improve their practices and to work together on addressing a range of responsible investment issues, but obviously climate being the most prominent. So the scale of the challenge we face is bigger than private sector or public sector alone, and we need to catalyse all sources of funding. In 2022, the Investor Agenda launched a global investor statement with investor signatories that urged governments around the world to rapidly implement priority policy actions that will enable them to invest the trillions that are needed to respond to the climate crisis. More than 600 investors, representing almost 42 trillion, signed up to the 2022 Global Investor Statement to governments on the climate crisis, ahead of its final showcasing at COP27. The level of ambition in public policy has grown dramatically in recent years. The 2023 report, The Changing Climate Policy Landscape, from the founding partners of the Investor Agenda, identifies how industrial policy has shifted over the past couple of years, particularly in the US and Europe, to deliver large-scale financial stimulus to the energy transition. However, we know that there are a lot of successes we have seen have taken place in the global north, and we're still not seeing what we need in relation to developing countries, in particular those most vulnerable to climate change impacts. The report underlines how much work still needs to be undertaken. This is not a one-size-fits-all solution, and we need to work collaboratively to identify barriers to private sector mobilisation in the global south as well as the global north. In this session, we're going to explore the impact of the current policy on investors and how can governments better respond to the challenges and investors. And so I've got a great panel here. I've got Faith Ward in the middle, who's a Chief Responsible Investment Officer for Brunell Pension Partnership. Bertrand Millant, who's the Head of Sustainability at CDPQ and a board member of Ceres. And Harry Cho, who's the Head of Sustainability and Sustainability Finance at the Singapore Exchange and a GFAN steering group member. So a really great panel. So I'm going to ask first to Faith, long-term climate commitments need short-term policy actions. How can policy action help investors to scale action on climate?
Thank you, David. And as I say, Brunel Pension Partnership, we're an asset owner from the United Kingdom. And I think public policy is crucial to investors. So one of the things I wanted to start with is also sort of a bit of a shout out to investors to say that, you know, if you want to express your views, if you want to articulate that dependency, then your climate policies, your transition plans, however it is that you're going to articulate your plan of action on climate needs to put public policy advocacy at its heart, because that is, I mean, that we are, as we've outlined and we'll expand on in this panel, there is that, you know, we need that enabling policy environment, and in fact that's really come through when we've seen today some of the draft text from the response to the global stocktake, that recognition of private finance, and that clear enabling policy environment being kind of very supportive of that sort of enabling of those financial flows. So in terms of what the sort of policy environment's done, I think what we've acted on as investors is some very high level sort of strong messages around committing to net zero, including some countries have made it legally binding. And we've seen that sort of underpinned by programs like Fit for 55 and the IRA program in the States. But what we need more globally is that certainty, or at least that clarity of objectives, particularly in the real economy. We need that consistency and we need that continuity. And that's why myself at Brunell and 32 other investors alongside the PRI, IGCC and UK CIF wrote to the UK government in what can only be described as their wobble when it comes to their sort of climate commitments more recently. And just to put a kind of reality check, I think, on that, that's obviously from a UK perspective, but and as David indicated, the policy environment is actually quite messy, particularly if you're a global investor. I mean, I invest globally and therefore need to deal with a multitude of different sort of policy environments. I think Adam indicated in his opening remarks about familiarity with the frictions, even for the most committed Paris-aligned asset owner. And we are focused on real-world change. So I think one of the things that we're quite keen on as well is that when we're held to account, that there is nuance built into how that accountability is enacted, because particularly, and David mentioned about those essential flows to emerging markets and developed economies. If we don't, we need this to be contextualised with the policy reality in which we operate, not just the aspirational one, but the reality of that. Otherwise, it could have catastrophic impacts, I think, on those capital flows if we are too blunt in how we hold ourselves even to account in terms of our objectives, and it's sort of keeping it real. So that's the sort of some initial sort of thoughts and reflections, David.
Thank you, Faith. So yes, policy advocacy is at the heart of our work, but those points about the fact that we need to have certainty and a consistency in the real economy to enable us as investors to get our money at work, but also how at a global level the jurisdictional differences really do challenge investors. So thank you for those points. Bertrand, the question for you is, in North America, how is Canada and the US, if you want to comment on that, addressing short-term policy actions to accelerate the transition, and how is this affecting investor sentiment?
Thank you, David, and thank you for having me here. I think what we have seen with the IRA in particular, and it's well publicized, and Canada has been catching up behind it, is a boost to the development of new technologies, batteries, hydrogen, carbon capture, renewables. However, there's still a lag in the decarbonization of hard-to-abate sectors, or even sectors where technical solutions exist today, and I'll come back to that. CDPQ, we manage 420-something billion Canadian dollars. We're an asset owners, largely in equities. We're a leading investor in renewable energy that we do directly. And a few years ago, we announced a commitment to invest $10 billion in brown or black to green, really to try to decarbonize hard-to-abate sectors. It has been a hard slog, largely because it is very difficult to find opportunities of that nature. There are some in power, and this is where we've done most of the work, but not in cement and not in steel. And one of the issues is that there is no pricing of carbon. Even in Canada, where we have a national carbon price, it doesn't apply to that kind of industries because they're exempt, or they're shielded from it through free carbon credit allocations. So our job in the end, in the finance sector, is to earn a return for our constituents by providing dollars and taking risk. We're not providing steel, we're not providing cement or electrons or electric trucks. That's the role of industry. And there needs to be, we can only finance industry to do these things. And in the commodity industry, it is hard to be a first mover, because if you are, and we all know that providing green steel or green cement is more expensive, at least today, than providing the grey sort. Well, these people who do that and are the early movers are likely to have an economic or financial problem, especially as those plants cost hundreds of millions of dollars. And so we've seen little advances in industries in that respect. So what needs to be done? I think what we need is clear signals, and you hear the refrain, I'm not the first one to say it, clear signals from industry. I think what we need to see is raising the playing field. You know, capitalism will result in innovation, will result in competitive juices flowing and solutions that are optimal. But the problem is we need to prime the pump. If you wind back the clock 20 years ago in the renewable industry, governments did just that. They mandated the production of renewable electricity that was way more expensive than grid costs. And then it got done. And as a result, economies of scale, technological progress, etc., the cost of green electricity came down. And that's exactly what we need to do in those hard-to-abate sectors, in our view, is to say, when governments say, well, I want to build a bridge, hey, mandate green cement, green steel. Somebody's going to find a way to produce it. And then there will be economies of scale, and the prices will come down. So that's, and this also applies to all sorts of other sectors. You know, we were having conversations with distribution, so food stores, dollar stores, etc. And again, there are solutions there to decarbonize their supply chain, particularly trucking. Short distance trucking between their warehouses and the plants in cities can be electrified today. Solutions exist, but the problem is they won't move because their competitors are not moving. Again, governments need to say to the industry as a group, whether it's Home Depot or a supermarket or a dollar store or clothing stores, people, we want 20% electric trucks by X date. Let's get moving. And therefore, then they're likely to do it. So that's the type of things that we need.
Thank you, Bertrand. I love that. So the IRA is boosting new technologies, but the hard-to-abate sectors, as you described, more problematic. So we need the right signals to get the creative juices from industry working, to get capitalism being able to innovate. So thank you for that. So Harry, how are governments and regulators in the Asian Pacific region scaling short-term policy action to transition to a low-carbon economy?
Thanks, David. I'm going to leave what needs to be done for the second question because I think there's quite a bit to say on what is happening at the moment from short-term perspective as well. I think it's fair to say across Asia Pacific, which is very economically, socially, super varied. You know, it's not one block at all. But generally speaking, I think it is fair to say the tone of governments and regulators has been one of inclusivity, engage rather than, I guess from investors' vocabulary perspective, divest. And it's critical because once you start to think about, of course, the social aspects, it's only natural. And therefore, what we're seeing is a mix of carrots and sticks rather than fully sort of regulatory policy-driven route. And the sectors of focus tends to be, of course, financial institutions who are moving in some ways ahead of the real economy, and energy sector, because that is such a critical component of the transition, climate transition across Asia. Two components that I would like to raise, where there has been some policy action. One is around disclosure. I think that perhaps is one of the easier starting points, and therefore we are seeing mandatory reporting rolling out across Asia Pacific. In Singapore, starting with listed companies, sustainability reporting has been mandatory since 2016. Climate-related disclosures have been mandatory since last year under TCFD. And this now, it is going to extend to private companies of certain size. That's not just happening in Singapore, but also being seen in other parts like Australia, among other countries too. So you're going to see climate-related disclosure, which is going to be bedrock of some of the other components, such as mobilizing capital or forming transition plans, etc. So, it's good to see not only regulators of the capital markets, but the broader government that actually regulates other sectors as well, rolling out more level playing field in terms of disclosure. And there has been proliferation of, let's say, more carrot side on trying to find level playing field with digital data inputs. I think it's a stretch to say it's fully digital at this point. So I think one of the critical components is to make sure that the platforms that are being created across the different jurisdictions are going to be tied up for interoperability. In terms of supporting the net zero and critically the word transition is coming into central focus. I know it has very different connotations, but it is a word, transition finance is a word that is being more and more embraced across Asia because you have to finance the transition. So it is being looked at from two components, from risk mitigation perspective, as well as mobilizing capital. So transition planning, many are saying there is a difference between transition planning and transition plan, including the regulators. So sort of looking at the frameworks around what do you have the right tools and governance in place for having the planning versus the plan itself, right? There is increasing support for having the right, more sort of regulatory-driven planning component. Carbon prices, whether that be tax or sort of the compliance carbon credits markets, these kind of components are bubbling up here and there across Asia as well. But there does need to be some level of caution there in that I think Singapore has moved ahead in terms of setting clear trajectory in terms of carbon price. You speak to some of the companies who are affected by that, and it does hurt them. About it, what it means is there is this, you can move from one country to another, so you have to also think about additionality there too. So yeah, these are some of the key actions at this point from short-term perspective.
Thanks, Harry. So recognising the diversity of Asia, there's a mix of carrot and sticks, but disclosure has been the initial focus, climate-related disclosure becoming increasingly mandatory, and now moving to sort of net zero and transition planning, but like that distinction between the difference between transition plans and transition planning, which is an important distinction. So let's move on to the second series of questions, which is around how governments are better responding to challenges and investors. So Faith, despite increasing pressure, recent climate conferences have failed to agree on a phase down of all fossil fuels, let alone a phase out. Why is this important, and what do you expect from COP28? What are the climate solutions, do you think?
Thank you, David. It definitely seems to be like a hot topic of COP28. It's quite a tricky one. I mean, Brunell itself has been very clear about its commitment to phase down, phase out of fossil fuels out of the economy, but it is about out of the economy, not just out of our portfolios. It's also about that transition, and Henry covered that really well in terms of her remarks about kind of the carrots and the sticks that are needed to bring that about. And Stephanie mentioned about differentiated pathways in terms of there are different solutions in different places, which makes, again, back to this sort of policy question around kind of needing that sort of nuance across those different areas. But they do need to get that carrot and stick framework right, if you like. I mean, we've seen an all-time high in respect to fossil fuel subsidies, about 7 trillion in 2022, and that was a particularly, obviously, reaction to the sort of the energy crisis we had. But I think what concerns me is that short-term reaction is being used to move and merge into a more medium to longer-term strategy to not address this issue and not address it effectively. Henry spoke about the fact that it is that price on carbon that is essential if we are actually to make this happen. I was listening to a panel on CBAM I know how to have a good time at COP. One of the phrases I took away from that, from one of the commentators, is the price is not the cost. And I thought that was really stuck with me, that one sentence, and about that needing to kind of to factor in that true social cost to the impacts of fossil fuels. Without it, this is just not going to happen in a bubble. So they keep making this kind of like, oh, we want to sort of phase down or phase out fossil fuel. It's just not going to happen unless we get this sort of this framework right. I mean, thinking about sort of, and there are also some disincentives and incentivization also on the upside in terms of the sort of climate solutions. Brunel has invested hundreds of millions in climate solutions, but we are facing some pretty strong headwinds in the short term, particularly in things like offshore wind. The cost of capital has rocketed quite spectacularly, and the policymakers need to keep up with the market reality. I think one of the ways in which this has shown itself and that policymakers need to be more agile is the recent auction of offshore in the UK, where basically there were no bids, so they've had to go back again, come back with a new price. They just need to be much more agile and recognise that if they want some of these transitions, if they want some of these phase out and the focus on that sort of climate solutions, then they can't be doing it in sort of a vacuum of all the other kind of normal cost, inflation and everything else that's happening sort of in our economy. The other thing I want policymakers to kind of think about in terms of this sort of this shift that they want from fossil fuels, and absolutely welcome the commitments to increasing the renewables, but I think, as David said on the last panel, that grid capacity and thinking system-wide is absolutely essential. Just to put some figures around that, to put that in context, we believe between now and 2040, we're going to either need to build or refurbish 80 million kilometres of grid. That is more than we already have and done in the last 100 years. So the scale of that grid capacity that needs to be built is phenomenal. So it's about actually get those carrots and sticks sorted. You need to properly, and what do I want from COP? I need them to get that sorted. You cannot continue to faff around regarding fossil fuels. We need some very, very clear signals if you want the transition to happen. We also need the policymakers to keep with the market movements and the reality as investors that we need to deal with on a day-to-day basis, and make sure they're thinking system-wide. It's not good enough to just think of some of these things in isolation. So those are sort of three kind of takeaways I'd leave with you.
Thank you. So, need to get the carrot and sticks right. Price is not the cost. I really like that too, because we need to really build in the true social cost. Policymakers need to be more agile. And did I hear right? Did you say 80,000 kilometres of
80 million,
80 million
kilometres of
There's
grid?
More grid, and that's in the last 100 years more than.
That's more than we've built in the last 100 years, and we need to build that to either build or refurbish that between now and 2040, which isn't very long in sort of infrastructure terms. That's
the challenge.
That is quite a steep challenge, but just thinking that way. So.
Thank you. So, Bertrand, regulatory requirements and disclosure regimes have accelerated action by investors and corporates, but are global regimes sufficient? And if not, where are the key gaps?
Thank you. I think there is an effort to tighten regimes, disclosure regimes, and they're very, very important. We need, collectively, investors need to be able to distinguish the advanced players that we invest in from the laggards. And we need to know, to have truthful information to make that kind of decision. That would help us invest the money in players that are oriented towards the future, taking and aligning their business model with where the world is going, and potentially shun the ones that are not. So we do need this type of disclosure. And coming back to the other point and what Faith was just saying, I'll give you an example of questions of the grid and the need for integrated thinking. One of our depositors is the Pension Fund of Quebec City, and among their boards are firemen and policemen. And I was at a meeting with them. We interact with our clients, and he was explaining how transformers, which in North America are the top of hydro poles, explode regularly now, and because people have electric cars, and the electric grid in Quebec is entirely green, so it makes a lot of sense to have electric cars, but the transformers explode because there is too much load. Hence the need for government to think, government owns the utility, to think, well, if I'm promoting electric cars, I need to do something about the grid too. It doesn't work in isolation. So integrated thinking. In emerging markets also, we are talking a lot, and we need to do a lot more in emerging markets. That's absolutely critical. We all know that, and that's where most of the emissions are today and will continue to grow. So there's a lot of work that needs to be done, and there's been a lot of discussions on blended finance, which is critical. So that's great. We now have a great new shiny screwdriver. It's less clear what we're building. It's less clear because, again, governments are here negotiating their targets. Hopefully, they have a transition plan. Hopefully, they know how they're going to achieve them and what does this mean sector by sector, etc. But we need to know, and they need to start thinking, okay, and David alluded to it, tell us where they want transmission lines and renewable projects and what to do about their adaptation projects. And if there's industrial projects that need to happen, let us know. And they need to tender them. We can't just show up, CDPQ, and say to a government, guess what, we're going to do things for you. We'll probably be accused of corruption for the right reason. Public tenders is key, and we need transparency. Investment will only happen if it's done properly. And so they need to say to the private sector, this is what I want you guys to do and prepare the projects. And then I believe that with blended finance, or even if projects are well prepared, maybe we won't even need it. There will be capital that will be available. There are also some other aspects, and I'll go into the weeds. I was talking about trucking earlier. We're having conversations with a large player in the field who are explaining to us the detail of this industry. When trucking companies buy new trucks, it's the big players that buy, the big rich players that buy the new trucks. And then they sell them to the smaller players who, after a while, sell them to the mom and pop shops, which are the bulk of the industry. At each time, obviously, the people who are buying from the previous owners want to make sure that these things are working. There's a huge question about battery life and technology. And there is risk there, residual risk and residual value risk, which is completely unproven because long-distance electric trucks today don't exist. And so I'll end with a note saying we need to have dialogue at the industry level. Finance can help. Insurance may be able to take some of the risks. And there needs to be a dialogue between governments and the trucking firms with finance to figure out a way to resolve that thorny issue. In the same way that David was talking about the pension funds talking to the government what needs to happen with the grid, or cement or steel. Dialogue and civil society, not forget. We need to have much more dialogue.
Again, I love that. Nice. We're building a nice shiny screwdriver with blended finance, but what are we building? You've given some really nice examples of where we need to have that dialogue to create the right policy settings to deal with the problems as we roll out the new solutions. So Harry, just to bring us home, there's plenty of scope for scaling policy in the Asia-Pacific region, but where do you think governments should focus?
Yeah. So, first of all, I'm going to start using the word wobble. That's a very nice way to put it. I think it's very important that policymakers and governments don't wobble, keeping in mind that the future is not written. Things will change, technology will change, and therefore policies will change, etc. But, long-term signaling is very important and perhaps should be driven by certain principles. And some of those principles, which I'm very, and SGX overall as well, very encouraged by, that we're already seeing being embraced. Perhaps I can mention three. One, we do have to be inclusive, therefore we have to be future-looking in terms of the impact not only on the real economy but on the finance emissions, and this has been a big topic across many investors groups as well as internally too. I've just lost my trail of thought.
Point two?
I've lost my trail of thought. It just went out of the room. Yes, so I think ensuring that future-looking component being a key principle. As I already mentioned, tying up the real economy sector with what the finance sector is going to be focusing on in terms of the targets and KPIs, extremely important. And thirdly, taxonomies, of course, they are, fun or not so fun topic, but there are a slew of taxonomies that are coming out from Asia, some of which are world innovating, and of course, these things will evolve over time. But looking to provide some level of regulator-supported definitions around what is a future-looking transition that is time-bound across different sectors when it comes to financing of them. And so if there could be linkages of some of these transition type of taxonomies, which will give a level of sort of level playing field for investors to focus their definitions around, that will probably also be very, very helpful. And finally, last night at dinner, I ended up coining a term that I think someone said they'll make a t-shirt out of it. Collaborative practicalism is one that what we're witnessing here, the likes of GFANs and all the investor alliances here, extremely important, and a lot of these alliances are now really cross-cutting between public sector and private sector and COP here at COP28. And in fact, the most interesting discussions were behind closed rooms. These are the most important discussions that we can be having to find practical collaborative solutions.
So what was the term? Collaborative?
Collaborative practicalism.
Okay. There's another one to add into the dictionary, but really important. And I also love the future's not written. I think that's really important. We can't be passive. We should not be passive. If we just sort of stick into our lanes, then we know that we're not going to achieve the transformation that we need. So I think that's again been a fabulous illustration of the way in which investors have understood the problems, how they're trying to practically find solutions. But I think you've been given lots of really good examples in the real world around how the policy linkages need to be underpinning the transformation. And just to end with saying that one of the things that was announced this week, there was a H-Leg report last year which talked about the transition to net zero, how to drive the process. One of the recommendations in there was recommendation 10, which talked about creating a task force to create a forum in which policymakers and regulators work with investors and other parts of industry to identify the hurdles to net zero. And that task force has been now announced, and PRI is delighted to play the role as the secretariat for that. And that will give us an opportunity, I think, to bring cross-jurisdictional regulators having a direct dialogue with the practitioners to identify what needs to be unlocked to create this acceleration that we all need. So we will, as the Secretary General said, he's expecting a fulsome report on the progress of that task force at next year's COP, so we've got some work to do. But thank you, everyone. It's been a great panel.
Okay. David, everyone, thank you very much. Really wholesome discussion. And it's been a long day. And it's been a long several days. Feels like months, I think, for some people already, including myself. I think sometimes you need to get re-energized. And actually, what I found out is go over to the green zone, go to the energy hub. It feels like the first 1,000,000 kilometers is getting financed and built today. There's a real action in terms of industry who are, you know, the transition is underway in their eyes. And I think it's quite important for all of us, for the finance leaders, for policy leaders, to actually see what's happening in industry today. But let me try to give a couple perspectives, including partly from the UN, in terms of where progress is and isn't being made. First of all, we extremely appreciate, and I think many people appreciate, the idea that 7 organizations can work together, not to come up with 7 frameworks, but to try to bring together. And I'll talk about the ICAPs later. I think is a great example of where, as an investor supporting organizations, we can come up with single common frameworks, and I think we need to do more of that. Before I get going, I do want to quote, because there's been a little bit of controversy in the last couple of days, and I want to quote Secretary General Guterres from 2 days ago with regard to this issue about oil and gas announcement. And he is unequivocal, and I'm quoting him, "The promises made clearly fall short of what is required." He's referring to the oil and gas, the announcement they made. "The commitment on the elimination of methane by 2030 is a step in the right direction, but the announcement to achieve net zero by 2050 says nothing about eliminating emissions from fossil fuel consumptions, so-called scope 3. So he was being very clear, and actually UNEP, my mother organization, we've been working with the oil and gas industry on methane tapping methane emissions. It's incredibly important. We know it can buy us some time, but the Secretary General is very clear. This is not a net zero commitment. This is one piece of the puzzle, and I think what we're talking about here, how do we take the holistic, the big picture? And we need to focus on not what we can do and what we like to do. We have to focus on the rest of the portfolio, and this is why I'm really pleased to hear the discussions going on. Now, everyone's always asking everybody, I get the question, how's it going at COP? What's happening? And I think we have to admit, all of us are in a fog. You know, no one person can say they really know what's going on everywhere. I think credit to the Emiratis, you know, the historic decision on day one to establish the Loss and Damage Fund was incredible. It's never happened, a decision on the first day. Extremely important for building trust. Now, you know, the piddles that have been put in so far, less than $1 billion, we know is not fit for the challenge, but the notion and the idea of developed countries understanding and saying that we do have a responsibility to help developing countries respond to climate shocks, that is a very big improvement step on just 1 or 2 years ago, I think, within the process. So that was very important. The negotiations are fairly slow right now. As you probably know, you tried to read what's going on. You know, it's painful, and as you might have seen, typically what happens, you have the heads of state come on the first due day, do a big rah-rah-rah and try to give a mandate to be ambitious. Then you get the technical negotiators who try to draft up a text, and every word of text that's not agreed gets bracketed. And then around now, what's supposed to happen is the technical negotiators are supposed to pass it on to the political negotiators. And the problem is there are too many brackets today. And so the political, which are the ministers, they've actually pushed it back, and they said, no, you need to reduce it down, because we can negotiate, but we can't negotiate on hundreds of items. We need to boil it down. So there's more work to be done. I think, as you know, the reality is the real progress happens in the final hours, or, you know, and essentially that's when negotiating positions start to become realistic in all ways. So there's a lot of positioning going on. We have high hopes, I think, in terms of some of the key areas. Article 6, emissions trading and carbon trading, the new modes for doing this, particularly between countries, and then how they can use that. It's very important, including for issues like managed phase-out in certain industries. For developing countries, the issue of the Copenhagen 100 billion, which hasn't been met. One of the problems with it is the definition of what it is still very confused. They are negotiating the NGCQ, is that right? Oh God, it's another crazy acronym. But essentially, it's the new commitment to start from 2025. They're not at the commitment stage in terms of dollars in, they're at the definition stage. And there's still more work to be done. And I think our view, and I think that from the investor communities, we need clarity on what's being committed. Is this a public commitment, or is this public as a sub-commitment to mobilize private? Because when you combine the two, it gets very blurry, which is what we've had in Copenhagen. Is this about mitigation? Is it about adaptation? So there are several issues that they're trying to sort out and get more clarity, and the hope is that they can then get a framework to actually have a full commitment round. The idea is it's supposed to start from 100 billion instead of being the floor, but then of course developing countries are hoping for more there. And we have issues around transparency, and we know we have discussions within the private sector, and as you all know well, but obviously also in terms of governments and how we communicate what's being done. We have the global stock take, which we know we haven't done nearly enough, and then just trying to discuss here about what do we say to help to accelerate ambition after this. I think developing countries would be very pleased to hear, Bertrand, your comments on the need to invest in the global south. And I think we all know that a lot of innovation is needed there, and also the relationship between public and private, which will be critical. I want to give congratulations to the Investor Agenda partners for establishing and working with leading investors on establishing the ICAPs. I think that creates a nice standard. It's been one of the main reference points feeding into the notion of transition plans for the investor community. It's been a very effective one, I think, so far. Stephanie, you had mentioned we need to move now from targets to implementation. I heard another reference, actually, I came from a similar meeting of bankers, which is what UNIP does a lot of work with, and there they basically, another take on this is to say 2023 was about the transition plan, 2024 has to be about transition finance, because we need more clarity, particularly for sectors that need to be transitioned. So it's not the pure green, or it's not those that are really, really not green, it's everything in between. And what does it mean? Including potentially, if you're going to work at finance transitioning, your emissions profile might go up, not down. So how do we reflect that? What sort of KPIs can we develop? I think one of the things we're seeing is that investors are being faster. We, UNIP, with PRI, we cover many of the alliances. We also cover banking, insurance. 2 days ago, we launched, or yesterday, I'm losing track, we launched the Net Zero Export Credit Alliance, so it's another piece of the financial system. Investors generally are at the front of the pack, taking the lead. I think you also can set the incentives more strongly, and you are being recognized in different ways. I think also there's an increasing understanding of the nuance, and Stephanie, you were calling for, in terms of this notion of accountability versus recognition. Where the Secretary General, he made that comment about oil and gas. It was actually a meeting on HLEG, looking at this notion of recognition and accountability. And all non-state actors were around this big table, representatives from government, mayors essentially, so subnational governments, industry, banking, insurance, investment. There was actually only one alliance who was asked to speak, and I don't want to show off, but it was the investors, the Asset Owner Alliance. And I think there's a feeling that investors in general are out in front, and you send signals to the rest of the capital stack, to the financial system, and obviously to the real economy. So I think that was recognized, and I would say that Gunther Tallinger, who presented, he was clear, speaking to the HLEG, he said, we are measuring ourselves against the HLEG. We do not meet all of the recommendations today, but it is a North Star, and that's what we're aiming for. And I think referring to the Janet Yellen, the Treasury's principles, similar. We think it's a useful tool. It's to give a very important sense of direction. And obviously, how do we get the fit between accountability and recognition is key. And I think it's very important that those in the UN, those in governments, understand these are voluntary frameworks. And therefore, there has to be something where the leaders get credit, but also in a credible way. But quoting Bertrand, implementation is a hard slog. This is not easy stuff. And I think it's easy, people in the UN to say, thou shalt do this, thou shalt do that. The reality is, as you are all seeing, is this is tough, deal by deal, framework by framework. We cannot oversimplify. Paul Pullman, formerly from Unilever, mentioned what I think defines the fundamental challenge we have you have as market actors is that today in the mode of climate action, we have a very serious bifurcation. And basically between the actors who get it and are doing it, and between the actors who are obfuscating and aren't moving. And we heard some references to that. And I think as we know and as we hear continually from the different alliances, you can only lead so far unless the rest of the industry comes along with. You divest in liquid markets, if someone's just going to pick it up, it's not going to make that much difference. So we need to figure out within the financial system, where are the laggards, and within specific spaces, who's leading and who's lagging and what can be done about it. I think this is a particular challenge, one to the IA, in terms of what's our role, because part of it is about transparency. How can we try to be making more information available? What's going on in the capital markets, which starts to shine a light. We're not an activist organization in the UN, but there are a lot of activists out there, and if there's more information, there will be more pressure, and we often do hear those in the lead, why do we get criticized? Because we're the most transparent. It seems like we're the ones who are always being criticized. We need to shine a light on the whole system.
Good evening. Apologies for interruption, but our time is up. I'm really sorry for that. I just wanted to let the event organizers know. Thank you.
Okay, thanks. Let me finish. That's a good signal. So I think, what can we do to solve that conundrum? And it's obviously not only our job, it's industry, it's organizations like ours, it's the UN, it's policymakers. And I think to Faith's point, policy wobbles do not help. And therefore, how do we create the ecosystem, the environment where all of you can succeed and you can bring the rest of the industry along with? Just a very final point on policy advocacy, very pleased to announce that today the AOA announced guidance on setting direction from members on policy engagement, essentially barring policy advocacy that is going to be contrary to the net zero goal. With that, thank you very much. It was a great day. I think it's time to reflect and get to it.
Thank you very much, everyone. Please use the door on your left-hand side to exit the room to allow space for the next session to start. On the left-hand side, please. Thank you.